Hey everyone, hopefully you're having a good day. My name's Andy, and we're back at it, looking at Twitter, seeing what people are sharing on social media. I interject my financial opinions as we go, generally related to three different topics. Wealth building, commodities, and financial topics is what I focus on and generally comment on. So let's go in there. Let's see what people are talking about, and I'll share my opinions as we go. If you want to follow me at finding_finance, and if you want to join our community, finding-value.com, we still have the LEAP coupon code that is open, LEP, 50% off the first month to try it out. It's only for the first month, that 50% off. And you can get a bigger discount on the yearly membership for anyone who wants to convert either a monthly membership to a yearly or a new subscriber. So coming on down, we've got, I think his name's Jorge, cross-border, huge increase in global commercial flying. The liquidity seems to be spilling into the economy. So the number of commercial flights tracked by Flight Trader 24, we are way above in 2024 those number of flights compared to 2023, which is fueling the demand for oil and oil products. So that's looking good. And it's also shows somewhat strength of the economy to some degree. Gold Silver says gold is wealth that has outlived two world wars, German hyperinflation, and the Great Depression, says Andy Schechtman. That is correct. There is no counterparty risk, and people flee to precious metals during certain market conditions. The question that someone should have is, well, are those market conditions coming to us now? And I do think that the market conditions are going to be ripe for precious metals to continue higher. Yes, um, there's a couple of conditions that metals do very well under. When the yield curve inverts and uninverts, almost all the time in history, gold does very well under those market conditions. And what it does is it basically positions itself, it moves higher and accounts for potential money printing in the future. So it's a fear trade and also a predictor of potential liquidity injections. And I think that type of situation could definitely come. I don't know the reasons why. I don't know how big a pullback could be. I'm just stating that the position of the yield curve is in that location. And historically, gold's done very well when the yield curve's in that position. Silver stocks are plummeting, and he's talking about the inventory levels, not the literal silver stocks, guys. LBMA's silver stock or inventory hits a 6-year low, signaling a tightening market. Look at the inventory levels down here. Very, very low for silver. We continue to go back down into very low levels. That is going to be a driver of higher and higher prices. The market is getting drained to some extent in certain portions of the world. Here's AMD. AMD is Advanced Micro Devices. You find them in computers, computer chips. It says AMD bear flag set up following a trend line breakdown, retest, and a continuation of the lower move. It's not looking great for the family here. So this is your trend line, hit, hit, hit. It's upward, and then we've broken through the trend line on the circle there. We've done a retest, and now we've got that big bearish flag pattern that is created, the bearish engulfing with the flag. That does look like we could potentially head lower for AMD. We're also seeing weakness in NVIDIA, SMCI, and other technology stocks. Could this be a top? People who call tops generally get ridiculed for long periods of time if they incorrectly call it, or if they call it and it goes sideways for 6 months or something like that, and then it goes down. To me, it does look like we are pretty toppy. It does not look at all like stocks I would enter for an initial position. That's what I'll say there. They look more on the toppy side. So they could be topping, and it could be a process that it needs to go through before it actually starts to go lower in a nominal term. But they do look very toppy to me. Calvin says most of the day traders on here aren't going to make it. Most of them wash out in less than a year. It's the guys with actual assets and income streams that are making longer term plays who will survive and thrive for many years. And I agree with that. The game that you want to play is you need to basically stretch out your time frame for like a decade, and then you get a buying point which may exist for 3, 4, 5, 6 months, maybe even a year or two. You're going to get buy points at a bottom. You buy in that bottom buy point, and then you wait for the market and the market conditions to change into that favor of asset and then pull you higher. He's completely right. You buy those actual assets that are going to do well over the next decade, and the income streams that you can earn over the next decade for the longer term plays that survive. That's a Warren Buffett, Peter Lynch, and all those types of approaches. The day traders, the ones that take the really short time frames, the reason they're not successful is because trading in the short term on a day-to-day basis has nothing to do with anything that anyone can control. It's basically just flipping coins at that point, and that's your statistical odds of making money. The fundamentals don't matter. The market conditions, they matter, but they don't matter on a day-to-day basis. So these guys that just guys or girls or traders who do this on a short-term time frame, there's nothing really there to do anything with. You're just basically going to get slaughtered based off of a mistake or many mistakes, or not even just mistakes. If the time frame is too short to make any money in, and then your emotions are going to take over, and you will most likely lose money. It's like 99.99% of people who try to day trade basically get washed up. It's not the strategy that I would adopt myself. According to Gas Buddy data, Sunday U.S. gasoline demand rose by 9.5% from the prior Sunday and was 4.5% above the average for the last 4 Sundays. I think that deals with people driving to see that solar eclipse, perhaps. And also, we're getting warmer here, so I can't imagine um, people not wanting to get out more. I mean, we're a lot warmer than we were the last 4 Sundays. EU natural gas, the refilling has started. Inventories in percent of full, EU's at about 60%. Germany's at 67, Italy at 60, France is at 42%, Netherlands at 53, Austria's at 75. Holy crap, that's full. And Spain's at about 79. But you can see that we never really drew down. That warmer weather in the winter did not draw inventories down as fast or as steep as potential other years. You can see the red line, and the steepness of this drop is much less than the steepness of the 5-year average and how low it actually drawed down into. All it takes is one really cold year where it's going to scare the socks off everyone, because you're going to get a steep move lower. We'll come back down potentially to very low levels. This is in a percent term. And that's where the price is going to rocket higher if we get cold weather. And I don't know what the weather will be like next year. I don't know, or this, I should say, this next fall and winter, but we'll find out. Vital sees oil at $80 to $100 this year with strong demand growth. That's a sensible range, Vital CEO Russell Hardy says. Demand set to grow by 1.9 million barrels a day in 2024, says Hardy. So we've got some people that are bullish, some groups coming out, and I've seen other estimates at like 90, 95. So there's some bullish bets that people are putting out there. Copper is entering a new bull market phase, Citi says, and obviously anyone who knows how to read charts can read this way before the news comes out, and we've been talking about it for a lot on this channel. Cubby says, is gold putting in a bottom versus Bitcoin? You can see that we've pulled on back. It's kind of a rough one to see, but it looks like it's putting in a bottom ready to move higher here. And I would say it is, yes. What would be the cause of that? Well, gold goes up during fear when the yield curve's inverted and none inverts. And then Bitcoin could go down with the overall markets, like AMD we saw above, which was falling to the downside. So we could see Bitcoin get dragged down with the NASDAQ while gold goes up. What that would signal is a market condition change, because Bitcoin's been outperforming. If gold starts to outperform, we might be entering a new paradigm of market conditions. And that is always where you get the most amount of gains, is when you can recognize what a bottom is and what it looks like, participate very early, size it up very early, and ride that bull market up. That's always the greatest spot for returns and best entry points. Copper, so this is again first target hit. So we can look at see what his targets are: 420, 440, 460, $5, 570, and 610 from this potential pattern that we've got. Those are the targets that he has, and I think it's going to go higher. I don't really play the target game, guys. What I do is I look at the ultimate potential return over a long period. That I generally calculate movements not necessarily based off chart patterns, but more based off of the ratios. And then I look for chart patterns that would suggest that it's possible on a long-term basis. This is a little bit shorter term basis than what I use, but the bigger, longer term, that's where I generally reside. And I try buying at ridiculously low prices with bottoming patterns in the technicals. Big liquidity drain for tax payments are ongoing. Be careful attributing macro narratives to an April pullback, says Warren. So we could get a pullback in the market, and he says don't be attributing that to macro narratives. It could just be liquidity coming for tax payments. In case you haven't noticed, the prices of gold and silver rise almost every day. Get used to it. This pattern will likely continue for many years to come. The only change will be much higher prices and even larger daily gains, in Peter Schiff's opinion there for gold and silver. And I agree with that. I agree with that because we've broken a lot of these big patterns. We've put in bottoming patterns in basically platinum and palladium, and everything looks pretty good as far as right now. But that doesn't mean that we go up every day or every month. What it means is we are now in an uptrend, higher highs, higher lows. Rick Rule says, Buffett points out that gold doesn't produce anything. It isn't intended to. It's insurance. And insurance doesn't produce anything. Go, Rick. I like it. Here's Gary. I want to talk about Gary here because he has a valid point about learning how to invest. He says, back at the end of February, no one could come up with any scenario where metals could turn and go up. And if you told them it would not only go up, but go straight up for one of the most powerful rallies in years, says you were an idiot. Well, I was trying to get people to buy, and I was told I was an idiot. Gold was only going to drop for the foreseeable future. Now everyone is convinced that there's no way gold can ever go back down. Traders are piling into the metals and into leveraged metal confident. There is no risk of losing money in this sector. This is exactly how the average retail trader behaves. They are bearish at bottoms and bullish at tops. I was bullish at the March bottom when everyone else was negative. I'm not necessarily bearish on gold right now, but I am getting nervous. I don't like when markets go straight up. Price gets stretched too far above the mean, and the market is at risk of a sharp regression event, regression to the mean. So while we're still holding full positions in metals, we are off leverage, and we are looking for the first signs of a potential top to cut our positions in half, and then in half again once a correction is confirmed. When everyone else is suffering from FOMO, I take that as a warning sign that we need to be on the lookout for a potential top. I suspect this may correspond with a top in stocks. If stocks suffer a hard move down, the selling pressure is likely to infect everything, including the metals. Once sentiment reverses and everyone gets bearish again, I will reopen the SMT to new enrollment. There's a lot of truth in this, guys. You have to be bullish when everyone else is bearish. You cannot make a lot of money in any other scenario. You have to be bullish when everyone else is bearish. And it's very tough to do for a lot of individuals, especially retail investors, because they find comfort in people holding the same view as them. And that is where an investor will make all their money. It's to be able to think for themselves and to be able to hold an opinion and a viewpoint that is contrary to everyone else. And I think most people cannot do that. They need almost someone else to do that. And I guess there's two different types of thinking: linear thinking and lateral thinking. I am not a linear thinker. I absolutely hate linear thinking. Like it just drives me crazy. And maybe that's what gives me my advantage, because I'm always looking for turning points. And I think my personality traits might link up quite well with that as well, for being an investor. So Tavi says, the ratio between junior and senior gold miners just poked its head out of a nearly 15-year resistance. This is a healthy sign that the recent run-up in precious metals is starting to propel the riskier segments of this industry to outperform the more established companies. Strong returns are necessary to offset the high risk involved in smaller businesses, and it appears that we are in the early stages of this trend. He's got a nice simple downtrend line where the juniors, GDXJ, is potentially going to outperform GDX, which is the larger companies here. Once those juniors start to outperform, you're basically confirming a bull market. Money's kind of flooding into the juniors and stuff like that. So I do think that we could see some crazy stuff go on in the miners and precious metals area. At least that's what my hope is, because I'm invested in this stuff just like everyone else. Coming on down, 5 sentences that hold trading wisdom from the past 40 years. A stock operator has to fight a lot of expensive enemies within himself. I've talked about this on the website. When you look at things, if you're going to be early and you're going to try to buy bottoms, you're not using price as a justifier to buy something. You're using patterns. And then once you buy it, you're going to fight all of these enemies that want you to basically sell it. It could be volatility. It could be anything in between, where something goes counter to your thesis or something goes counter to what you think is going to occur. And pullbacks are generally sometimes can be deep and sometimes can be many in a big bull market. And that's where the operator fights with himself, the expensive enemies, selling and the FOMO and getting scared, all of those things. In this business, if you're good, you're right 6 times out of 10. If you're never going to be right, 9 times out of 10. So you're never going to be right 9 times out of 10. He thinks at best you're about 6. So a lot of people, I see people give other people on Twitter crap, and it's like, guys, you can't make 100% right calls. You're going to get some wrong. It's part of the game. So in the business, if you're good, you get 6 out of 10. No one's going to get 9 out of 10. Number 3, single market secret to discover. No single correct way to trade the markets. Those seeking the one true answer to the markets haven't gotten as far as asking the right question, let alone getting the right answer. So there's no single market secret, guys, to discover. You might be searching and listening to YouTube videos nonstop, trying to figure out what that secret is. There is none. Now, there's ways that can increase the probability of success, and that's exactly what I've done. How can I increase the probability of my success? By aligning many layers deep of, I call it confluence of evidence, to increase the statistical probability of me being successful. And in all honesty, I am kind of surprised at the success that I've had implementing this strategy. I think it's actually greater than 6 out of 10, depending on how much risk you want to take. If you're favoring probability of success over the potential outcome, you can pick. I've picked some pretty good stocks that have high probabilities of success with very good upside potential. 4 says, why do you think unsuccessful traders are obsessed with market analysis? They crave the sense of certainty that analysis appears to give them. He is desperately trying to create certainty where it just doesn't exist. So another one is everyone's looking to see all of these opinions of experts on YouTube, and they're trying to weigh all of these opinions against each other. The problem is you're not going to get the level of certainty that you are basically looking for or are satisfied with. So then you have to look at other things. What's the probability of this occurring? Do we see good technical chart patterns? Is the business cheap? What is the value of it? If it's yes to all of these different things, that's generally when a business outperforms. But you're going to be buying it when no one else wants it. And that is the most difficult thing to do, is to buy things when no one wants it, but all of the signals are basically turning green for you to buy it. And that's where I think people just need experience. They need to know what it looks like. What does a bottom look like? What does it feel like? What does buying a specific company with a falling wedge and out of favor with a good ratio, what does that look like? What does it feel like? And almost like you have to experience it a few times to get a hang of it. Frankly, I don't see markets. I see risks, rewards, and money. And that I've talked about this as well, about the risk and how I value things. But guess what? Risks are not, people don't view risks the same, and risks are fluid in the market. They don't stay static. You have a whole bunch of different risks. And I hate to say it, guys, this is one risk that a lot of people don't think about. You know who the biggest risk might be when investing in a company? It might be yourself, which goes back to number one. Number one is a stock operator has to fight a lot of expensive enemies within himself, and that could be your largest risk. A lot of people struggle with themselves and are the largest risk to their portfolio is in fact themselves and their ability to control their emotions. That could be the largest risk for a lot of retail investors. So those are the 5 there. Coming down, we've got, just think, 3 months ago, the street saw 6 rate cuts coming in 2024. 8% interest rates would put mortgage rates at over 10%. And Jamie Dimon, head of the U.S. largest bank, warns of 8% interest rates along with recession. That is crazy. And maybe the 8% interest rates isn't being driven by the market cycle. Maybe we just have so many bonds and nobody wants our bonds that's one of the potential moves for interest rates to go up, or one of the reasons why interest rates are moving up. This is Michael Oliver. He says, chopping off the name of the poster because I'm not here to bring heat down on other people. Look, I get it. There are lots of investors who made their careers off stocks and bonds, paper assets, party risk. There's nothing wrong with that. But this is almost like willful ignorance of what gold is and the purpose it serves as the most permanent form of savings in the world with no counterparty risk. It will outlast all technologies and all economies just as it has done for a millennium. On another note, I'm extremely doubtful of AI being the strongest technological revolution in human history, but that's really just an opinion at this point. So what he's responding to is, in the midst of the strongest technological revolution in all of human history, and it's not even close. The Chinese buy gold. Just shows you, you buy what you're forced to buy. If I wanted to sink China forever and the CIA asked me to come up with an economic black ops, this is exactly what I would come up with. Force them to invest in the most unproductive asset out there, which you can do nothing with but bury in a hole again. And that was Michael Oliver's response to that. So coming on down, that is where I'm going to end it, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. Be a part of the community. We've got a question and answer session coming up on Saturday at 7 a.m. Mountain Time. That's the next one. And I'll probably haven't really decided yet. Some people want me to go over my mistakes, which then leads me to basically how I came up with the three pillars: ratios, technical analysis, and market conditions. That's to prevent me from making mistakes. That's why I developed it in the beginning. I've probably made every mistake possible, just like everyone else. And there's a bunch of mistakes, and maybe I'll go through those, and you guys can learn from my mistakes or maybe repeated mistakes that I think other people might be doing. But I talked about one of the major mistakes here: the battle within oneself and their emotions. And there's a lot of mistakes that are driven from emotions. So I'll end it there. We'll catch you guys next time. This is Finding Value.